It's Brent from TradeGuild.blogspot.com, and we're going to finish up with TNH. And what I was saying was, one of the reasons I like to buy half of the position here is because it allows me to have a wider stop on my original entry. And when the stock is trending, we can tighten up that stop. But when we're making a turn, we want to give it a little bit more room so we don't get stopped out real quick. And one of the ways you do this is just by having good risk management. I have a post called the 2% rule and position sizing on the blog, on the right side of the blog, under resources and concepts. And basically the 2% rule states that there's different functions of it, but the way I use it is if you have a $10,000 portfolio, you don't want to risk any more than 2% on any individual trade. So our risk in this stock, if it's at $21 right now, and say that's where we bought it, actually we bought it back a little bit further, but let's just say it's that, and $19 is our stop. That's $2 of risk. So we have $2 of risk. We have $200 of risk available, which is 2% of 10,000. So that leaves us 100 shares that we can buy on the initial move here. So that allows us this large position, this large, not position, but this large stop. And once the trade starts working in our favor, we can add to it. So we got the crossover there, and let's see what happens here. Okay, we got a nice day up there, almost 10%. And at this point, we're trending now. We're making new highs, so we can use a couple of different ways to stop out on this. But I like the trend channel, and let's see how that works for us. You can see it doesn't work when we're going sideways, so don't even think of it. You need to be trending, and you don't know you're trending, so you may think, well, this is a trend, and you get stopped out. That's the price of the game. That's why we keep our risk at 2%, so we can swing at a lot of balls. And here we go. So the stock is just moving up, and you can see everything's still in gear. So TNH was an industry laggard that has worked out pretty good so far. So I think the entry was around $22, and it's around $25.50 now. Let's take a look at NYMX, which is another one that was an industry laggard, and that was back in early August when its industry broke out. So here's the industry, and what was happening was this consolidation in here, and then we got this breakout through that consolidation. So we're looking for, now that we see money's flowing in to that specific sub-industry, we're looking for the laggards, and NYMX would probably come up on one of your screens. Let me zoom in a little bit so you can see the volume. So we've got some updates here. This back here is when we're forming our base. I expect to see a little bit of selling as we come down into that base. But on the up days, we're seeing green volume. And if we take a look at what's going on here, basically we're pretty much neutral over here. This may or may not have come up. I don't know. As we move forward a little bit, let's see what happened. That big volume back there is obscuring it. Yeah, so we're getting some more volume days up. And in any case, let's go ahead and take a look at what this channel would do, or this moving average system would do. Okay, we're in the sideways consolidation. A lot of whipsaws in here, and that's one of the reasons we have these extra indicators, so we don't enter in a whipsaw, or we do it as least as we can. The less. Never mind. So there we go. There's an entry right there at about 281 by the first pullback. So you could have gotten in on this day at 275. You'd have to see how it traded intraday, and let's see what happens here. Like I said, sometimes I do use this volume-weighted moving average as a stop, or sometimes I use the stop channel. But in any case, this stock moved up very nicely. The volume-weighted moving average held very well for a stop, and it's actually a tighter stop than the channel. So in this case, I would use the tighter stop to lock in those gains. Let's finally take a look at a stock that has really trended well, and we don't see a lot of these. That's why we keep our risk as minimal as we can, so we can take a lot of swings. And a lot of times we're going to get caught up in sideways movement, because 80% of the time stocks are going sideways, and 20% of the time they're trending up or down. So here's STEC, and basically it's going sideways. But basically what I want to do with STEC is we're just going to take a look at it. We're going to look at some whipsaws and how we deal with those. So we're going to start at the beginning of 2006. Let me just get some water. And we're going to look at the positions that we would have entered and how this worked with whipsaws. Like I said, I like it when it comes down like this and it reverses to the upside. And we would have, I'm going to zoom in a little bit tighter so you can see the crossovers. We'd have an entry here at 422 by the first pullback to the 10-day moving average at 4. So we got a better entry on the rest of the position. And at this point, you could try to throw it into the stop channel. It's not quite, now it's trending. So we could throw it in our stop channel. And let's see what the stop channel does over here. I'm sure we're just about to stop out. So our level to stop out is about 415 on a close. And we haven't got stopped out yet. Let's take a look at the other. See, now we would have been stopped out here. You see, we got a crossover below. We got a crossover below. That stops us out at STEC. So we're out at this point. And I just jumped way forward. Let me go back. And I think we were, yeah, here we were. So we got stopped out at this point. So we're going to wait for the next crossover. Okay, here we have a crossover at roughly 376. So we're going to put our stop, down in this level until it starts trending. Now it's trending. We can either use the volume weighted moving average or that stop channel. 22-day moving average too in blue sometimes works pretty well. So now in this case, it looks like we're getting stopped out right here with the crossover below and the crossover in our side below. Also in the stop channel, we would have been stopped out probably on this day here at 395. So let's keep riding this and see where we go. Okay, we're in a little downtrend. Okay, we have another crossover here at 389. And then we get the takeoff. So this is what I'm saying. We want to keep our risk small so we can get these big winners. And look how that volume weighted average price holds as support in this case. And look at it just trend up. This has been a monster trender, really trending well. And a lot of stocks just don't trend this way. Here's the stop channel. You can see we would have remained in the stock on this day. It didn't close below. So the stop channel worked and the volume weighted average price worked. So I'm going to go ahead and wrap this up. If you have a telechart on tonight's Warden report, October 6th, this whole system with all the formulas are up. And if you don't have access to that or you want to talk about it more, you can leave a comment on the blog or catch me at the tag board or shoot me an email and I can give you some more information on it. This is not a perfect system. It doesn't work every time. It's just a system and it is a set of rules. And like I said, I wanted to show you STEC because we went into a couple trades. We made a little bit, we got stopped out, made a little bit, got stopped out, maybe lost a little bit, and then we had this big move from $4 to $9, and that's what we're looking for in the market, at least the way I trade. So thanks for listening, and if you have any questions, feel free to ask. Good night.